So what can happen is if Bed Bath & Beyond starts to challenge this price area, if any call contracts have not already been delta hedged by the market makers who sold them, then they'll have to start buying in this area in order to make sure they have enough shares to meet their obligations. And from that point forward, it causes the price to rise a little bit more. So much so with the number of call contracts that are available in the market that it can actually lift the price enough to hit another trigger point. So once the stock starts challenging the next strike price, market makers then have to start catching up and start hedging these options as well. And this can cause a runaway effect that keeps causing more and more shares to be demanded by the market makers. Now, hello, everybody. My name is True Demon, and I am the Devil Stockbroker. For this video, I'm going to be covering Bed Bath & Beyond, ticker symbol BBBY. We like to call him Bobby here in the Discord. So Bed Bath & Beyond has had a bit of a rough year in 2023. We had a massive move last fall where Bed Bath & Beyond skyrocketed to an insane level, more than 450% of its value the previous month in just a 3-week period. I believe at the height of it, Bed Bath & Beyond hit a high of $30 after trading at a low of $4.54 just a few weeks prior. So the massive move in Bed Bath & Beyond came on news of Ryan Cohen's involvement and potential buyout of the company. As it turns out, Ryan Cohen kind of rug pulled everybody by selling his entire investment in a single transaction at the top. And he definitely fleeced retail investors on that one. You can take that for what it is, but I'm just going to say very bluntly that Ryan Cohen used retail hardcore and he sold out from under everybody. So that aside, Bed Bath & Beyond is coming up on our radar again, and it's for very different reasons. So Bed Bath & Beyond it's basically gotten straight up slaughtered, moving all the way down to a low of $1.20 in the time span of 130 trading days from that point. Now, Bed Bath & Beyond has been establishing a bit of a floor at the $1.50 price level, so it's been hanging out down here for a few days. What's interesting about this location for Bed Bath & Beyond is while it was trading in these higher price target levels, there was a big options chain that was formed in all of these different areas. I would suspect that a good bit of options were created or written in these price levels when Bed Bath & Beyond was trading at, more than $10 and $20 at these insane valuations. But what ended up happening was it left behind a huge options chain for everybody to stare at for the next several months. And what I just noticed is that ScourgeBot has alerted us to the fact that there is a significant gamma ramp on Bed Bath & Beyond. If you want to learn more about gamma ramps and how they work, there is a tutorial on the YouTube channel that I will link in the description of this video that will explain how we detect gamma ramps and what they are and how gamma squeezes work. For this video, we're going to focus strictly on the data, and we're going to go ahead and analyze some of this. The big thing to focus on is that Bed Bath & Beyond has a very large options chain, and it has a new strike price every 50 cents or so. So we're going to base off of Bed Bath & Beyond's float according to TradingView, because remember that Bed Bath & Beyond recently did an offering, so there's currently a 113.5 million share float right now. So I'm going to direct your guys' attention to this table, which shows the Bed Bath & Beyond live call options open interest percentage by float. Now, Bed Bath & Beyond currently has a float that is estimated at 113.56 million shares. So we have to keep that number in mind in the back of our head for how many shares are supposed to be legally traded in the market, not counting any naked shorts or anything like that, any synthetic shares. We're going to pretend that those don't exist for a moment and work with the most conservative numbers that we possibly can. And on this chart, what this is showing is it's basically showing the open interest for every given strike price on the y axis and the expiration on the x axis. So when you look at this chart, what it's essentially showing you is clustering of call options on the options chain. And if you draw your attention to the lower left hand portion of this chart, what you'll easily see is there's a significant amount of open interest clustered around the $2 strike price and the $1.50 strike price for all dates in March, all the way into April, as a matter of fact. So this clustering of call options is fairly interesting because it's happening at a time where Bed Bath and Beyond is at the lowest point in its chart. This is the lowest that Bed Bath & Beyond has traded. It's actually within just a few cents of its 52-week low. And this massive clustering of open interest in calls at these prices actually creates an opportunity for a gamma ramp. And when I say gamma ramp, I'm referring to the amount of options that need to be delta hedged by any market maker or broker dealer that wrote those calls in order to provide them to meet market demand. What these what this creates is a situation where market makers need to have shares on standby in case these calls go in the money. If they don't, as in if they sold naked calls and they don't actually have the shares to cover these, what can happen is the price can start climbing as they are forced to buy shares in order to hedge those calls. So we have a situation where this massive clustering is occurring for every single dollar strike all the way up to $5. So every 50-cent level that you see marked here on the chart is actually a significant level of resistance, but is also potentially a triggering point for a gamma ramp to be executed. So what can happen is if Bed Bath & Beyond starts to challenge this price area, if any call contracts have not already been delta hedged by the market makers who sold them, then they'll have to start buying in this area in order to make sure they have enough shares to meet their obligations. And from that point forward, it causes the price to rise a little bit more. So much so with the number of call contracts that are available in the market that it can actually lift the price enough to hit another trigger point. So once the stock starts challenging the next strike price, market makers then have to start catching up and start hedging these options as well. And this can cause a runaway effect that keeps causing more and more shares to be demanded by the market makers. Now I'm going to show you the really exciting chart that demonstrates how severe this problem actually is for the market maker. If you look at the gamma ramp chart, what this is showing is the amount of floats, the percentage of the float that would be in the money at a given strike price. And this is based off of the float numbers that were given by TradingView at 113.56 million shares. So remember I said to keep that number in mind. So currently now, the market price is at $1.62. That means every single option, every call option that is $1.50 and below is currently in the money. That puts us at approximately 10.7% of the float. However, if you jump up to $2, then 20% of the float is in the money. If you jump up all the way up to $3.50, you get 40% of the float in the money. $4, it's almost up to 50% of the float. And you can see where this problem starts to manifest itself in the form of a demand and supply imbalance. What this means is that there's not enough shares in the market to cover all of these call contracts. Not really, because there's institutional holders that are hanging on to the float, and they're not going to sell it right away just because the price lifts by a few dollars. But if there's major volatility in the stock market and market makers are forced to hedge all of these options, They need those shares to meet their delivery obligations. So what happens when nobody's willing to sell the shares to them, but the price keeps going up as a direct result of their delta hedging activity? This actually puts market makers back up against the wall, and it it's basically forcing them to torture themselves because the more shares they buy from each other in order to meet their delivery obligations, the more call contracts they're going to have to hedge for, the more shares they're going to have to buy, the higher the price is going to go. And this domino effect happens so quickly. So I've frequently referred to another gamma squeeze where this occurred. There's only two other times in my career that I have noticed that there has been more than 100% of a float of a stock available for purchase on the call chain. The first one that was most recent was Redbox. So this was Redbox, and the gamma ramp actually showed up as a result of this move that occurred here in April and May. And when it came back down here, a whole bunch of people bought all the call contracts that were opened up at $6 and $8 and $7 and $9. People started buying all of them up, and it forced the price to go ridiculous. It almost reached, I think, $20. Yeah, the high point was $18.20 according to Chart Exchange. So this is one example of a smaller gamma ramp. I think it was 50 or 60% of the float was in the money below $10 when this happened. So it created a huge move to occur. It caused a huge move to occur because of market makers being forced to hedge those options. And then the other famous one is SPRT, which was support.com before their merger went through. They had a big pop that caused a whole bunch of call contracts to get opened up in this price level between $5 and $15, and the price collapsed back down. But about 4 months later, in August, it started to rise up again, and then once it blew past the $10 mark, more than 100% of the float was in the money at this point, which created a demand so high that there was not enough supply of shares available in the market to meet it. And 1 week later, SPRT went to its all time high of $59.69 from $8. That was when I got my position. A lot of people were in it as far down as like $4. I got in at $8 and it blew through the ceiling and went all the way to $59.69. I didn't even top tick this thing. This was the most magical one that I had ever seen, and easily is bigger than BBIG was because it was like the price only had to move by like $5 in order to put more than 100% of the float in the money. But Bed Bath and Beyond is not small by any means. Like this one is huge. This gamma ramp is actually so large that if the price went just to $5, it would put an additional 50% of the float in the money. Market makers would have to basically buy half of Bed Bath and Beyond's market cap in order to meet that demand. So you can easily visualize how insane that price can get.
It's
Yeah.
just, is it even possible though? Is what I'm saying.
Well, that's the thing is mathematically it's not possible for them to meet all of this demand. So that's what can happen here is if retail starts buying even more call contracts at these higher strike prices, and then they continuously keep buying shares and cause the price to lift high enough, then once it actually triggers that runaway effect, like all it has to do is break like maybe $2, maybe $3 within the next 2 days, and it could cause Bed Bath and Beyond to skyrocket in a couple of weeks. The amount of calls that are available to purchase on the market right now at around $2. I think for the next couple of weeks, like these are only trading at like less than 30 cents per share. So for $30, you can get a call contract. And you think about how small of capital that is for that much leverage. You could spend maybe, yeah, for $300, you can get 10 call contracts. Anybody with that kind of capital, like if you think about the number of apes that are in the market that are trading like this, they easily have the capital to buy a few thousand more call contracts between them all. So essentially, this leaves us in a situation where Bed Bath and Beyond is trading within a few cents of its all-time low, literally its 52-week low, um, and it has all of this call open interest just sitting above it, hanging out there. As a matter of fact, the interest in calls is 62% to 38% puts, which is a massive ratio in favor of calls. So I'm estimating based off of the live options interest chart that I was showing earlier that if Bed Bath and Beyond can break this $2 level, then it can at least get enough interest to get retail's attention and get them to start going back into the play. Because at that level, you have all of these gaps after this massive drop where the stock was struggling around the $2 level. If it can break that and get all of those contracts in the money for the next 2 months, then that would be enough support underneath it and enough of a gamma ramp above it that you can see Bed Bath and Beyond in just a matter of weeks do something like this. Not an exaggeration, also not financial advice. Like none of this is guaranteed to happen. This is all speculation, but this is the potential for gamma ramps because when market makers start delta hedging, they do it very quickly because it's all done algorithmically. There's very little human decision making that takes place here. So once it breaks a technical level, the computer doesn't care. It's like, okay, we got to hedge and we got to hedge now. Start buying every share and getting it from everywhere you possibly can. And when they start doing this, they all start competing for price. And when you run out of shares in the market, probably somewhere in the neighborhood of $3.50, that's when they're really going to run into supply chain issues. They're not going to be able to find shares in the market to meet their obligations at that point because of how many calls are on the market. And that's when they start competing with each other. And then the price goes parabolic after that. So there's no price targets on this. I do not give any price targets because it's too close to financial advice and it's too speculative for me to do anything like that. But just based on what Bed Bath and Beyond has done before, there was no gamma ramp involved in this, and the price went from what $5 all the way to 30 in a matter of like 2 3 weeks. So insane things can happen in the market like this all the time. But the gamma ramp chart that is provided by ScourgeBot can give you a very easy and very clear visual illustration of just how insane it can get and how quickly it can happen. That's going to be it for this video. I hope you guys enjoyed it. If you found this information helpful, be sure to leave a like, subscribe if you want to see more and get more content. And if you have not heard of us before, we are Hell's Trading Floor. You can join our Discord at discord.gg/Hell's Trading Floor through our website at hellstradingfloor.com. Thank you guys so much for watching, and I look forward to seeing you in the next video. Until then, have a hell of a time in the markets.